All right, so take a look at this chart here, right? I'll put it up on this side. Where is that chart? Okay, so there's the chart. You're looking at, if you're not familiar with this, you're looking at gold versus 10-year yields, real rates, and the real rate is inverted. So you'll notice that as far back as '06 on this chart, gold had a very neat, perfect almost correlation with rates, with real rates. And between '06 and before that, and 22, that correlation remained static. And it remained static because people were pricing opportunity cost. And to price opportunity cost, which is, the higher rates go, the less likely I am to own gold. When you're pricing opportunity cost, you are pricing an assumption that you will not lose your core capital. You're pricing how much can I make, not how much can I lose. And then in 2022, something happened. And what happened, it's been happening for a while, but what happened very markedly was in 2022, the Ukraine-Russian war started, and the US sanctioned, not just sanctioned, confiscated, froze assets of China, of Russia, which signaled to the rest of the world that anyone who goes against the US in a way that we deem appropriate can have their dollar-denominated assets confiscated, stolen, taken from them, depending on how you look at it. And so anyone in the world who does business with the US, who has to hold dollars, and that's pretty much everyone, started to say to themselves, well, if we have our money in dollars, if we have our money in treasuries, and we have it in the SWIFT system, well, then we're vulnerable to that reality too. And let's face it, if the US is going to sanction and confiscate the wealth of a nuclear power, what's to prevent them from doing it to us? And so nations that had already been de-dollarizing slightly began de-dollarizing at an accelerated rate, with China at the forefront. So the rates started to diverge in 2022 because people stopped pricing the opportunity cost of their money and started pricing the return of their money. As the expression goes, I'm not worried about the return on my capital, just the return of my capital. And so China started selling more treasuries, or put it this way, they also stopped buying treasuries with their profits. And a portion of that money that was liquefied was put into gold. Every nation in the world did that to some extent. More obvious coming out of emerging markets, and with China at the tip of that spear. And so gold stopped being a slave to rates, and it started to move higher because they wanted the gold. Because they wanted the gold, not they wanted a return on their money, they wanted a return of their money. And not only did they want the gold, they wanted it physically in their possession, on their shores, in their vaults, which leads to the collateral crisis mentioned by Zoltan Pozsar in 2022 and manifesting now with the LBMA in a crisis, with the Bank of England probably having too much gold encumbered under their roof than they care to admit, and with the repatriation of gold to the US in competition with China, I would say, probably to refill our own vaults, which are currently filled with moth-eaten IOUs. All right, so that brings us to 2022. Since 2022, with everything I just described, in a macroeconomic sense, correlations broke down. So the dollar would get stronger and gold would still go up. Yields would get lower, or higher, I should say. This is inverted. And gold would still go up. And all the macro bros were saying, oh, what happened to, the correlation is going to snap back. And then after a while, they stopped talking about it, which brings us to now. Right now, everyone is saying correlations are dead. Gold no longer cares about the dollar. Gold no longer cares about yields. That's complete horseshit. We can get into why that's complete horseshit some other time. But as long as you can buy and sell gold in dollars, and as long as the U.S. economy is one of the biggest in the world, then Dollar valuations will affect gold, as will yields. But right now, it's not a major driver. So let's go to actually what I wrote here. Gold fixed chart note on the right. When rate US dollar correlations began to break for gold in 2022, we welcomed it, writing many times that it was a secular physical demand forces disrupting Western financial correlation complacency, stating macro tools no longer matter in secular change. Most ignored this. Then, when it became obvious, quote, they wanted the gold and rates were not driving demand, trust was, many said correlations are dead. We said not true. Trust was dead. Correlations always exist. However, they had to reset like a beta before being reliable again. Now, looking back at the chart again, rates are reasserting themselves as gold price drivers, but so far only in being supportive of rallies. High Sharpe ratio with a positive bias, aka old school Sortino ratio, is really what we're looking at here. This is perhaps the beginning of the beta stabilizing at a higher level. Certainly, anyone who is buying it, gold, in the West because of rates or US dollar behavior can and will sell some of it if these trends reverse. The bottom line is correlations drive Western public investor demand as always. Eastern demand is driven by a monetary reset or rebasing against gold as the US dollar is no longer suitable for them. Long story short, if rates keep dropping, or real rates in this case keep dropping, which means the curve, the dark line goes up, people will buy gold in the West. Will they buy it in the East? Maybe, maybe not. But the key is what happens to gold when real rates start to climb again? Will people stop buying it? Well, maybe the East will stop buying it. I don't believe they will, because they will no longer have dollars to worry about their opportunity cost on. In the West, we will buy gold more if rates increase, because it will likely be because of inflation risk, which is what Hartnett said, or because another banking crisis is relevant. In the West, we are more and more concerned about return of our own capital and less concerned about return on capital. The concept is spreading. The next statement Hartnett says is actually a warning or a measuring stick or yardstick to determine when and if gold will accelerate higher or crash. Here we go. Hartnett, gold is the best hedge against full-blown trade war, said 52% of investors in B of A Feb Global FMS. That's fund manager survey. 15% alternatively said the US dollar, 9% said 30-year US Treasury bond, reversal of US trade policy. I would argue quickly that these are all the same thing. And that's what Hartnett is saying. They're all the same thing. They manifest in lower real rates. He's spot on here. Okay. He goes on to say a reversal of US trade policy equals a reversal of gold. I want to tie these things together here. Hartnett says real rates and trade policy continuity, meaning we keep doing what we're doing, are key for institutional upside buying.